the title of this webcast was about the $15 trillion opportunity. That really refers to the $15 trillion that's going to change hands from my parents to me, or your parents to you. And it's not that the baby boomers are retiring, and baby boomers are expiring. They're in their 80s now. Cash is going to change hands, stocks, bonds, real estate, companies. Wealth managers are licking their chops right now on this whole transition. I'm 55 years old. I'm the father of 3 college kids. I'm originally from Montana, but I've lived in Seattle for 27 years. We're lucky enough to live in a region, a city that has 16 Fortune 500 companies here in the Seattle area, from Boeing to Microsoft to Amazon, etc., Costco. And half my career has been in operational finance and half in corporate finance. I was the CFO of a company that we took public in London, then CEO of that company, then sold that company. But early in my career, I came to Alexander Hutton at the age of 27. It's the oldest investment banking firm in the Pacific Northwest. We've done 231 transactions. So when I was 27, I came in as an intern in between my 2 years of business school at the University of Washington. So I've made Seattle my home. I had to pick a city that was somewhere near Montana, and Seattle was it. And so I get back and forth to Montana quite a bit. I have a home there. But when we sold that company, I came back to Alexander Hutton and started working in M&A. And that's after a tour through venture capital, 6 years in venture, lots of different roles in investment banking, and knew what it was like to invest in companies, sit on boards, but I really didn't have the experience of actually being an operator. For the folks who are on this call, I don't know all your backgrounds, but you are the heroes as far as I'm concerned. You're up there with priests and teachers, building businesses and supporting families and your communities. And so we are a firm that only works with sellers. And sometimes those sellers are looking to just take some chips off the table, de-risk, what we call indemnify the family. And some of those folks are in their 70s and want to move off into the sunset. And of the 231 transactions, a third have been manufacturers, a third have been software, a third have been everything else. And so,
what size transactions?
From 2 to 15 million EBITDA. It's called the lower middle market.
Okay.
It's where most of America is. There aren't a lot of $50 million EBITDA businesses outside of Chicago, Atlanta, New York, and LA. So we're firmly where the volume is, and all of the managing directors, and we've got a dozen people here just working on transactions. All the managing directors have built and sold companies ourselves. So we think that we have the ability to give advice, and I think Ben Surdy was on your show as an example of the advice that we can give ahead of a transaction to really generate value for you and value for us, because we only get paid if you have a successful transaction.
So from that perspective, what separates a good business from one that's sellable?
I think the word durability is the word that I always use when I'm judging a company. Is what's the margin structure like? What are the unit economics? What's the nature of repeat revenue? How old are the customers? How many years have you had them? EBITDA margins matter, but so do gross margins. From an income statement standpoint, you want to have a clean balance sheet. Fewer owners are better than lots of owners. You don't want to have a over-levered balance sheet with a lot of debt. Debt can be useful, And as long as your returns on capital exceed the cost of that capital, you're winning. But too much debt, is imprudent in my opinion. So durability always comes back to the team, customers, the cost structure, and really most importantly, that if you get hit by a truck, or I really like meeting business owners who like take a month vacation. That tells me the business can run. If you can only take a 3-day vacation, you got to work on your succession planning.
So how far in advance do you get involved with sellers?
Well, I mean, I'd love a deal. Walk in the door, and 4 months later we're done. That's a rare occasion. I've worked with some clients for years, but we tell our clients, and we have a dozen clients right now in a variety of industries. We tell them it takes 6 to 9 months to sell either part of your company or all of your company. And part of your company is a recapitalization. You're selling 60% of your company or more, and you're staying on for the next second bite at the apple. But you've got to pick the right partner, because you're a minority shareholder once that cash hits your bank account. And that's part of our job, is to make sure you have alternatives. Ben Surdy was on here, and I think he took some liberties with the truth, to be honest with you. And I would tell him that. But we had probably 35 SIMs out, so confidential information memorandum. I want to say, he probably had 15 offers on the business. So that's 15 different parties that wanted to partner with him to grow it.
Yeah.
And, you don't want, that's on the high end. Sometimes people want to I sold a business here called Southwest Plumbing a number of years ago, and they wanted to keep it quiet because they didn't want the plumbers leaving when they heard the business was for sale. And I don't really like the words M&A. I like momentum and activity. I don't like mergers and acquisitions, to be honest. I like partnership. You're not selling out. You're staying on. You're de-risking, your portfolio for your family. And so, I think it's the words you use. You're looking for a partner if you're looking for a recapitalization, or you're looking for a buyer that sees the vision and has the wherewithal to take it to the next level.
So how do you know a seller is truly ready to exit, and from one that's not really? I'm sure you have a lot of experience dealing with that. Yeah,
ultimately it's your decision. Everybody in you all run in packs. You all talk to one another. Everybody's heard bad stories about selling their company. But I think once you've hired an investment banker, you're serious about doing something. And the investment banker only gets paid if you're successful. And there's a point in a deal, and sometimes it's 3-4 months into it, where you get a sense of whether the seller really wants to sell and the buyer really wants to buy. And there's some moment when you reach loggerheads and somebody rolls, and that either means that the buyer wants to buy or the seller wants to sell. And I've been in hand-to-hand combat with public companies and private companies, and being able to say no is probably the most negotiating leverage you have, is saying no. And I always tell all of my clients, keep running the business like it's not going to close. Do not make, and also I always tell them, I'll run the deal, you run the company, and keep hitting your numbers through due diligence. Don't start focusing on the deal and lose sight of the prize. Keep your eyes on the prize.
So a lot of these 2 million EBITDA to 15 million EBITDA are acquired by a certain type of private equity companies. Who are those guys? How would you describe them?
So there are 7 million private companies in the U.S. with owners over 55. So let that sink in, 7 million. And then on top of that, there's 2,500 to 3,000 private equity firms. And there are another similar number of family offices. I was just on the phone with a family office out of Vancouver. And then you got the private debt guys, which is 10x what the private equity guys are. So, you know, we sit in the intersection of a lot of deal activity. The title of this webcast was about the $15 trillion opportunity. That really refers to the $15 trillion that's going to change hands from my parents to me, or your parents to you. And it's not that the baby boomers are retiring, and baby boomers are expiring. They're in their 80s now, and they're going to, cash is going to change hands, stocks, bonds, real estate companies, wealth managers are licking their chops right now on this whole transition. And there's a lot of planning that goes into a transition. I can talk about that.
Yeah.
But you know, that's the macro world I live in. Is there's a lot of transactions that are going to occur, and you want to have an advisor, just the team of advisors around folks who want to either sell part of the business or all of the business. Includes your wealth manager, your accountant, your investment banker, your attorney. So that's the team around you to make sure that it's done properly. And there are lots of
let me go back a second on that. We mentioned private equity, you mentioned family offices and the debt fund. Where are the which space or what type of companies are the private equity guys targeting, and what's the difference between that and what the family offices are looking for?
I think the private equity folks, you know, there's so many private equity firms that they're all trying to corner a certain market. So if you, like you know, I'm selling a material handling company right now. There's probably 50 private equity firms that just buy material handling. This is automating a warehouse, that just focus on that. Name an industry, I probably can find 50 private equity firms that are interested in taking a look. Maybe 100 in some industries. That just peruse a website. It'll say things like value-added distribution, business services, light manufacturing. They want, you know, they want high margins and low capex. You know, that's, and then they lever their bet, so they borrow 6, 7 times EBITDA on the high end, 2.5 to 3 times EBITDA on the low end. But that's how they amplify their returns, is the use of other people's money.
So how about the family offices? What are those guys looking for?
So family offices are unique. Usually a family office would have made money in a particular industry, and then they go out and they know that industry really well, and they'll focus on that industry. That's what I find. The ones that are sort of, you know, investing in lots of different businesses, they're really trying to pay low multiples. When you pay a low multiple for a business, you can make a few mistakes, and it doesn't crush you. If you pay a high multiple and you hit the market at the wrong time, it can crush you. And so I found the family offices to be prudent. If I were buying companies, which I do not do, I only do sell-side M&A for operators. I don't work for private equity firms. In fact, I spend most of my day jousting with private equity firms who are trying to exploit my clients. And it's not because they're bad people. It's because the profit motive is to buy lower and sell higher.
Yeah, that makes sense. So how do the debt fund come in play?
So the debt funds, I sold a company a couple of years ago where a CEO wanted to buy out a founder, and we got a bunch of private equity guys lined up. It was a business services company, and we had met a few of these debt funds, and the debt funds, you know, I said to my client, Tom, I said, Tom, if you buy out Harry, you know, you're just trading Harry for a private equity firm. Like, how is that beneficial for you? And I said, you take this debt route, your business is very very fundable from a debt perspective, high recurring revenue, great 28% operating margins. It was a service business. If the business went down, you could just get rid of employees. And that sounds sort of crass, but that is a reality. And why don't you consider debt? And so we raised the debt, and I was just on a phone call with them last week. They've raised the debt, paid down the debt, and they still own 80% of the company, the management team. So there are different ways to structure these things, and some funds will be equity-like. You know, in that case, the company, the fund came in and lent them the money, and then had a 20% equity put after 6 years. So if they exercise that put, the company needs to buy back 20% of the stock at the historical EBITDA multiple, but EBITDA is greater now. And so they've got to figure out sort of what the next steps are there to that equity puts coming up. So that there are ways in which debt players can be kind of quasi-equity, and that's an example of that.
Interesting. So there was that, were they servicing that? Was there payments happening on?
Yeah.
That's why, or were they holding
Nope.
payments?
Well, on that one, it was interest only, but they paid down the debt pretty aggressively at a decent return. The debt fund is very happy with what their returns are. And one of the things we do as a firm is we actually run the numbers the way the private equity and private debt holders would run the numbers. So you know what it's like to be in their shoes. What are they trying to do in the structure they're recommending? And every a deal that closes, and I don't close everything I work on. I think I bat better than Ted Williams, which I think he was a 400 hitter. He's in the Hall of Fame. But every good deal is really a three-legged stool. It's the best price, the best structure, and the best cultural fit. And cultural fit, you won't really know until something goes wrong what kind of cultural fit you have.
Yeah, that's a tough one. So what are some of the trends that you're seeing right now in the lower middle market?
I think the trend is your friend when it comes to people getting old. I have probably 10 private equity or family office or private debt player banging on my door saying, show me deals, show me deals. So that hasn't changed over the last 5 years. We kind of, we got through COVID, we got through the interest rate spike. When you look at going up, on the 10-year, you went from 0.5 point to 5 points. You're right around 4.25 now. We ran the numbers and showed that the price of the company only has to go down 10% to make the numbers work out, to generate the IRR that the limited partners of that fund needed. So, real estate, was affected differently downtown Seattle. Downtown office is pretty banged up, but, data centers and warehouses are pretty good. And multifamily has been excellent. So the trend is people are getting old. The economic cycle will do whatever it, does. But, if you thought your business was worth $20 million and you could sell it for 18, would you sell it for 18? Most people would say yes.
Absolutely. So give us a story of an interesting deal that you've done. You can even tell us the story from your perspective, Ben, if you want. And then and I'd love one that's like a terrible deal. So give me like a good deal and a terrible deal.
I think Ben's was a great deal. It's a great deal for Ben. It was a great deal for me. And what I'm most proud of is that I cold called him. I picked up the phone and I begged him for a meeting. And when you're 55 and you're still cold calling, it means you haven't lost sight of where you came from. And so I'm proud of that.
How did you come across him?
I had sold another business in Montana, where I'm from, a restoration business. And he said, I'd like I like that story of Mark. I want to do a Mark deal, is what Ben said to me. And as he outlined, I said, well, you know, I've tried to sell a few of these businesses. You're only focusing on the high margin stuff, and you're actually outsourcing them a lot. And he's like, well, you know, construction and I don't know what the backgrounds of all the folks who are on this call or not, but in restoration, you know, it's contents and actual restoration that's profitable, and construction's, pardon the French, but a ball ache.
Yeah.
And so he's like, no, it's so difficult, James. And I said, Ben, the buyers want a full stack offering. I hear it from all the time. They want to own the consumer from beginning to end. They don't want, you know, they want to have a brand, brand loyalty. You've got a great brand, but you're not doing your construction. He said, well, I know a guy who actually could run it for me. And for 12 months, you know, that construction only made 20 cents on the dollar. So it wasn't as good as the 40 cents over in carpet cleaning or in restoration. So we did that, and we ended up getting 15 or so offers, and we brought 4 of the top bidders to Seattle, and we had half-a-day meetings and meals. And I got a call from one of those parties saying, you know, we love Ben. What's Ben's number? And I called him and said, Ben, this is the Willy Wonka moment. We don't get these moments very often in my business. And I don't want to reveal anything that I'm under NDA with, but, you know, it was, you know, Ben talked about being in bed for 2 weeks. I had to hold his hand, and now we're great friends. And, you know, in some ways, Ben's a guy that has dedicated 100% of his life to his business and his family. And I took him fishing in Montana to my home there with a bunch of other business owners. And he sat around the campfire. He said, no, James, I don't have a lot of friends. It's like I've spent my whole life on the business. And then when he sold that business, he had a bit of a crisis on his hands. And no new Ferrari solves that crisis. You know, and the stories he told me about the things that he bought. That was his retail therapy with Bentleys and Ferraris. If he's on, I don't know. Maybe he is.
No, he knows. It's very common. It's not, and I mean that's like a very common thing.
Yes, it is.
Post exit.
I think there's a business that Jay that you should start that is post acquisition therapy.
Yes.
So that was one transaction, and you know, maybe once a year I have a transaction I work on that doesn't close. But I have 2 of them I'm working on right now that were supposed to close last year, didn't close because the business got a little choppy in the middle of due diligence. They lowered the price by 25%. And I said, let's not do it now. Let's wait a year. I know how durable this business is. You've had customers for 30 years. This is a durable business. And when you hire me, I'm Alexander Hutton, we act like shareholders. We don't act like bankers with you know, high rent lifestyles that need to close deals to pay for our house in the Hamptons. We act like shareholders, and you want to have a banker who works with you who has that mindset, because that is true alignment.
So aside from sales coming down a little bit, revenue coming down a little bit, what are some of the things that can get the business a deal paused or stopped or completely? What are some of the scenarios that you've seen that kill deals?
I think it's mostly revenue. It's not, you know, it's you lose a major customer or you lose, you know, that's usually what drives. It's not a cost related thing because you've been at it for so long. You know your costs. You know, having your books buttoned up, doing reviews on your financials. What's revenue recognition? is this year's revenue really this year's revenue, or was it last year's revenue? That kind of thing. You think your EBITDA is 3 million, and then some accountant from the other side comes in and moves the revenue back, and you're like, oh shit, I only have a $2 million EBITDA business. You know, it's mostly tied to revenue, and you know, we've sold businesses that were leaderless. Most of the time, you want to sell a business that has a team that wants to take you to the promised land as an investor or as a buyer. But there's a lot of things that. Last year, I sold a business where at the end of the deal, the buyer came and said, we need to keep 2 payrolls in the business at close. And I said, well, isn't that kind of in the working capital negotiation? And he goes, no, it's unrelated. It's a cash-free, debt-free deal, but we need you to leave $800,000 in the bank. And I said, well, do you want me to go tell Rory and Mike that their purchase price just went down $800,000? He's like, James, it has nothing to do with your fee. Your fee is good. And I'm like, I cannot believe this guy is asking me to do this.
What was his explanation? Why did you want 800,000?
This is just how we do it. And you're at the end of due diligence.
Oh.
And you know, you don't sell your company unless I buy it, right? And it was just, and I said, well, I'll be honest with you, we're going to take this off the market, and we'll take it back to market in 3 months. And it was slimy. And so there's a lot of slimy stuff that happens out there. And what he was trying to say to me was, when I sell it, James, I'll use you to sell it. That's another offer I get all the time. They put their arm around you. Hey, sell me this company, and when I flip it, you're my banker. And I'm like, well, I mean, 70% of my deal flow comes from my personal network and my former clients. Ben's a good example. And I don't really, you know, it's always somebody turns to somebody on a golf course or in the duck blind and says, how did you sell your company? And it's really satisfying to get deal flow out of your former clients.
That makes a lot of sense. So what are those like structure? What have you seen, like, in terms of like deal structures? What are some of the basics and then the interesting? I
would say, you know, 70 to 80% of the offer should be in cash. You're gonna be a minority shareholder. Somebody else going to be driving that ship, so you want to take as much cash as you can. Sometimes there's a seller note to kind of keep you engaged and skin in the game. Not that frequently today, in today's market anyway, but I have seen those. Then there's always the rolling of equity, which is 20% of the price is in equity. It's really important that you get the same class of stock. A lot of these guys will say we're preferred stock, and you as the rolling shareholder common stock. That's kind of like riding in the same plane, but you're in coach and they're in business class.
Yeah.
And that's insulting. If I could give any advice to these guys, don't try that one. If you really are in a partnership, you're in it together. You have the same rights. And so cash, seller notes, rolled equity, important to get the same class of stock. That's probably the typical structure. If you're being bought by and let's talk about liquidity for the second bite of the apple. It's important that if you're going to sell to financial buyers, you're going to have to wait for them to decide when they sell the company. So you have to be comfortable in that ride. Mm-hmm. If you're selling to a strategic, then you can negotiate a put call that allows you to sell the stock at a certain time. And so those are really important. And I've been through those with large public companies and gotten involved with my client as they're exercising that put to sell their stock to make sure that their interests are represented They had attorneys, et cetera.
On that first one, when you roll equity into the fund, at what valuation, and how do you kind of verify that valuation? Are you going into that deal?
It depends on if you're the first company or you're the sixth company.
Yeah.
You know what your business is worth because the offer has been made, and hopefully you use somebody like Alexander Hutton and they got you multiple offers.
Yeah.
You know what the market is for your company, and obviously there might be a step up because you're number 6 of 5 other acquisitions, so together they're worth more. But you need to pay attention on what percentage of that combined entity do you own.
Yeah.
It's I like to say that I spend my day doing 6th grade math and 9th grade English, but just watch Shark Tank. The game is all about percentages.
And as you're rolling into that entity, do you get a chance to due diligence what
Yes.
they have? Okay.
Yes, that's part of our job.
Okay, so you have the ability to due diligence and see what's in that fund and see how what the total EBITDA is, and okay, and then on the other side where you get a put, what valuation, when you do a strategic deal and you have a put in the future, what valuation are you doing that put at? Is it existing, or is it like something that's predetermined, or?
I suppose it's all negotiable, but
yeah,
I try to keep the EBITDA multiple the same.
Okay.
And if the EBITDA grows, then the business grows, and your 20% equity roll is worth more.
Got it. That makes sense. So what are some of the things that you have to watch for in terms of like the partner that you're gonna take that ride with? What are some of the elements that you kind of coach your clients on? Who to take that ride with, and who not to?
Yeah, I think it's it comes down to chemistry. It's like having being a part owner in a business. Do you have chemistry with your partner? And then determining that chemistry, talking to their other portfolio company CEOs. Tell me when things didn't go right, when the numbers didn't go right. What would they like to deal with? Everybody knows that what you do on a daily basis in your businesses it's hand-to-hand combat, and you're going to have some highs and you're going to have some lows. And when you talk to those other CEOs, ask them about the highs and lows. How did they respond? The debt player that I mentioned, right off the bat, they tripped a covenant, which means they didn't hit their numbers.
Yeah.
And they found out that, hey, these guys were new into their hold. It's very understandable. Shit happens. And, getting that chemistry right, spending time with them, there's not a lot of time to do that, but I think talking to their portco CEOs about their experience is important.
That makes a lot of sense. What are some of the common telltales of a good partner, and what are some of the common ones that are not someone not to deal with? Obviously, someone who comes and asks for $800K middle of the transaction, you probably have to I think revisit that whole thing.
I think when you get into fund 3 or 4, you're not a first-time fund. You have some seasoning as a private equity firm. You've seen the ups and you see the downs. Somebody's bet on you, the institution put their money into your fund versus somebody else's. So that's always a good sign when they're into a couple of funds. The one guy that's out there trying to buy companies on his own without any institutional capital is, a little bit more suspect. It doesn't mean they can't be good people and great partners, but they don't have the track record. And really, when I graduated from business school in my late 20s, everybody was going into venture capital and tech. It was the dot-com boom. Then there was a period where everybody came out of those business schools and they went into private equity. Now they're all a lot of them are out. I met with one last week at a Harvard Business School. He wants to buy a company, and so that build, the MBA to ownership, because they convince you in MBA school that you can run anything.
Yeah.
It's a fallacy, of course, but those folks are out there, a little less experience, and so I would bet those much more heavily than sort of a three or four fund private equity firm.
Yeah, it makes a lot of sense. So what have you seen that now lately? What's in if someone's going to go do a roll up, a brand new roll up today? What would you advise them? What would you tell them? What sectors, what industries should they go after?
I think recession-proof industries. That home services is all the rage now because they're recession-proof. Everybody takes care of their home. It's the number one asset, and so there's a lot of roofing, landscaping, restoration, plumbing, HVAC, electrical. Those are great businesses. And if I also would say that off the beaten path, places like Spokane, Colorado Springs, Eureka, California. There's wonderful businesses. Bend, Oregon. Where I don't know where everybody is, but the small towns with 100,000 people. Those businesses, they're not highly marketed. Most people don't know what an investment banker does. In fact, it's a misnomer by itself. It's not investment and it's not banking.
Not banking. Yes.
It's really advice peddling. So I would say off the beaten path, recession resistant, great unit economics. I think those are the businesses, and home services comes to mind. I've got a bit of a practice in material handling, which is automating warehouses, which I think with labor shortages and robotics is a major growth industry, but it's project based. You got to keep that backlog going in the pipeline, and but those are good businesses as well. But toilet paper manufacturer. Everybody needs toilet paper.
Any like B2B services?
Yeah, B2B services, IT services. We sell a lot of IT services. I have a partner of mine who built and sold an IT services business. That all comes down to what is your customer concentration? How long have you had the customers? And your unique offering. You can't be a network administrator. That's a commodity. But if you're in cybersecurity, that's not a commodity. And the threat is rising daily. So IT services, especially with a unique offering, are quite popular buyout targets.
Nice. The business, the customer concentration is an interesting one because it's very common. It's very common to find someone who picks up Amazon as a client or Microsoft as a client or someone, and then all of a sudden they are 40% of their business. How do you deal with that?
You need to find a buyer that wants Amazon or Microsoft. The standalone financial buyer is going to view that as risk.
Yeah.
But a strategic could say, you know what, I've got Apple and I've got Meta. I want to offer the same thing to Microsoft. And these guys are buy versus build, and they've got the relationships.
Okay, that makes sense. So when it goes into their portfolio of clients, it's not concentrated.
That's right.
Yeah, that makes sense. So are you, if you see someone like that, so your strategy is to go for those strategic as opposed to, okay.
Yeah.
And okay. And are you doing direct outreach to these guys, or like how do you market these companies?
So I'm using proprietary databases to identify buyers. Like I said, I probably have 5 or 10 that come at me every week, show me deals. Usually the the client knows who they're strategic, who they compete with.
Yeah.
And that ends up on the list. And for successful businesses, they've been approached by all kinds of people.
Yeah.
The people on this call probably get a daily call.
Yeah.
Saying, have you thought about selling your business?
That makes sense. I want to open it up for people to ask questions if they have them. So just jump in and ask, because I can probably talk to James all day. And so just jump in or raise your hand if you want.
James, do you work? I know you mostly work with a little bit bigger stuff. When you're working with individual buyers, what kind of red flags do you see, or maybe what kind of green flags do you see when you're not working with private equity on getting a deal closed? Or do you even work with that type?
Yeah, I work with individual buyers, and because I only get paid when the deal closes, I'm always concerned, do they have the wherewithal to close it? And if I were out trying to buy a business, Jeremy, I would tell the world that I've got 5 guys that are ready to back me tomorrow. And I don't know who they are, but they need to be on your list. If you're tying up with a family office, your investment banker wants to call the family office and say, are you really behind Jeremy? Because I'm already taking enough risk to get paid that if you don't have the capital, we've wasted a lot of time.
So your main concern is, can they close? That's the that's your main thing.
They have the resources. I don't really like working on deals where somebody shows up and says, I want to buy a company, and then they got to go get the bank debt, and they got to go to the country club and pass the hat for a couple $1 million. That's financing risk. There's all kinds of risks we take in these businesses, but the financing risk is the one that I try to avoid.
What else? What else aside from the financial risk? What else is a risk, from your perspective, in an individual buyer?
I think in individual buyer, I'd say, what's your background? I really love individual buyers who spent 10, 15 years working for somebody else and learning what works and what doesn't work.
Yeah.
And then having a strategy. There's a lot of folks out there. I just talked about people coming out of business school to try to buy businesses. They're just kind of casting the net. And to me, that's and most of those people have to kind of buy something that's slightly broken, and that's fine. I'm just not in the investing business, so I'm in the transacting business, so I wouldn't put my capital behind somebody who's going to go buy a broken business.
Yeah, it makes sense. So their background, ideally someone who's been in that space for a while and can articulate how they're going to add value to that business.
And their capital source.
And capital, yes. Okay. And in terms of what is your process when you're, tell us a little bit about your process.
So our process is, it's kind of a 6-month journey. And it's, 2 phases. One is marketing the company, and the other one is closing the deal. And the first half is telling the story. Why is this a compelling opportunity for a buyer to come in and make 3 times their money? Because that's what the IRR requirements are from the institutions. It is 3 times your money. That's what they plan to do. So telling the story of, I love, like a manufacturer. I just sold a chemical manufacturer, and I loved seeing how more revenue meant more operating margin percentage. That means they're scaled. So we get these guys some more volume, they get more profitable per dollar. I love that. I love that kind of story. That's scale. But our process is, the first stage is putting together marketing documents. It's usually a 30-page PowerPoint presentation. It has a teaser as well to do some pre-marketing. You want you want to start talking to buyers well ahead of the marketing documents being complete, because they help inform. Like, I've got this company, I can't disclose who it is, but they do this and that and the other thing, and oh, we really love those businesses, but you got to watch out for this thing, and you got to watch out for that thing, and then all of a sudden it kind of change your marketing message. That sort of marketing ends. You have the documents, you go to market. We're currently in market with 2 or 3 things right now, and they sign an NDA, they get the confidential information memorandum. We have a call with them, answer their questions. We gather up all the questions from all of the different parties. We put it into a frequently asked question, FAQ, and then we provide that to everybody. And then we'll have a call for offers. Might be, maybe 8 weeks into the process, we'll call for offers, which is just a indication of interest. How much are they willing to pay, and what's we ask 3 or 4 questions, and then we narrow that down. And usually we have, like we had with Ben, we bring in the 4 top offers to meet management and have a meal, break bread, understand the chemistry. Then we make a call for letters of intent. Everybody thinks that a letter of intent is the deal. It's actually the 3rd inning of a 9-inning baseball game. You just started the hand-to-hand combat. That letter of intent will lay out the price, the structure, what the source of the funds, are they going to lose debt? What are the nature of some of the reps and warranties and indemnifications? Then we decide. We negotiate against those top 4, try to get the best price, structure, and cultural fit. We sign the letter of intent, and then the real work starts. And that's the due diligence, which can take 6 to 8 weeks, which is accounting, legal, HR, insurance, technology. They all have, depending on the industry, all have different threads. Environmental, if you're a chemical manufacturer. And you're working with a dedicated M&A attorney who works with us, doesn't work for us, works for the client. And we then at the end of accounting comes first, and then at the end is legal, which all the deal documents are usually drafted by the buyer, and then the seller's counsel responds. And we get to the very end, and we have probably several times where you're going to walk away, or you're unhappy, or you find middle ground. And then the deal gets signed, the banker gets paid, and all the service providers get paid, and hopefully you've got a nice nest egg, and you've got a path to maybe go for that second bite of the apple. And at that point, I step out and root from the sidelines.
Nice. Is I'm assuming the working capital is a big part of that challenging period and the close.
Our deals are structured, I think most are, cash-free, debt-free.
Yeah.
Whatever cash is on the balance sheet's yours, whatever debts are on the balance sheet are yours, and those get paid off at close out of proceeds. So when you're cash-free, debt-free, I always find working capital to be kind of a funny negotiation, because it's GAAP accounting. It's current assets. So there's your receivables, your prepaids minus current liabilities, which are your payables, your accruals. And it should be just a simple, there's $1 million in the working capital between those pluses and minuses, and it should be that way at close, because the business needs a certain amount of working capital to generate the EBITDA, and they're pricing this on EBITDA.
Yes.
So it should be a pretty straightforward calculation, but I've had people come in and try to do it differently, and it's more controversial than what I
should be. So do you usually have a problem on the seller side or the buyer side? Is the seller trying to take receivables, or is it the buyer that thinks that the working capital is going to be higher because maybe seasonality, maybe?
Yeah. Which usually you take seasonality out by looking at the last trailing 12 months.
Yeah.
Maybe trailing 24 months if the business is growing really rapidly.
Yeah.
But it's usually the buyer. We calculate working capital $1 million. They say it's $1,250,000 because some of the receivables are too old.
Yeah,
or
makes sense.
You found some payables that you didn't have on the books. That kind of stuff happens. Yeah. And I try to keep my clients focused on the prize. The working capital calculation is minuscule.
Yeah.
Compared to the sale price.
Makes sense. What else aside from working capital? What else do you usually have the hard time at the end?
I think that's why having a really strong M&A attorney. Don't let the attorney who did your divorce or your office lease. This is really specific law, and so you really want to have market terms like for reps and warranties, which are the things that they're representations and warranties that you've done something in the past. You pay your taxes. You rep and warranty that you pay your taxes.
Yeah.
Or the indemnifications. You're making indemnifications that there are no employees that have lawsuits out today.
Yeah.
Made an indemnification. If that comes back, then there is a remedy.
Yeah.
To breaking those indemnifications. Usually you handle that in an escrow account, maybe for a year. They'll put 10 to 12% of the purchase price in a bank account in case. And sometimes, and more frequently today, there's a rep and warranty policy that you can buy so that it comes out of the insurance company. And usually the price of that premium is shared by both buyer and seller.
Oh, interesting. I haven't seen this one yet, so that's a good one. What else have you seen at the end that ends up getting stuck on?
I think some people just don't want to sell their company.
Oh, really? Okay.
I really don't like that. I don't really like clients like that. I'm not sure Ben really wanted to sell his company, to be honest with you. I know he's happy now.
Yeah.
It's the best decision he ever made. But, it can be emotional. And if Ben's he should win the Horatio Alger Award because he was his story is just mind blowing. I learned more about it around a campfire in Montana. He ends up in jail, running the business from jail. It's just only in America.
Yes. Yeah, he has an incredible story. So you deal with that emotional roller coaster that sellers go through. So what have you found? What's the one or two things that have you found that that work or help kind of navigate that challenge?
I really think that once somebody has gone through this rodeo of a transaction, they're ready. They've kind of made their decision.
Yeah.
I think having grace and talking to them once a week. How are you feeling? How are you feeling? And my chemical company I just mentioned. After they came into a big pot of money, that guy said to me, "You know what? In 1 year, I lost my company, I lost my wife, and I lost my best friend, who was the founder of his company. There was no money that could salve his wound, and he's probably still in mourning."
Wow.
And so, that's just a reality. And I think just being respectful and knowing that his company is in good hands. And he rolled equity as well, a small portion. So he wants them to be successful. And the company needs him, he'll be there.
So as soon as he sold, his wife divorced him?
No. She died
Okay,
about
I'm
a
sorry.
year before.
Okay.
She died a year before.
Because I've seen this on Twitter or X. Someone on the plane overheard some lady talking to her friend that her husband is selling the company, so she's just waiting for the closing to divorce him. So it happens.
She's smart.
Yeah. She's probably helping helping close the deal. So any closing thoughts around M&A? Like we have owners of businesses, we have people that are looking to buy. What's your kind of like a final thought or advice for them to do a great acquisition, great transaction?
I guess I'm just so bullish on this country. We're so blessed to be born. We're so blessed to have a blue passport. Yes, because anybody can start a company. You ever I lived in Italy for a while. You ever try to start a business in Italy, the red tape will kill you.
Yes.
And so I'm so bullish on this lower middle market. There's a lot of undermanaged assets. Mm-hmm. I've heard owners say, yeah, the one thing we couldn't do is we couldn't do the technology piece. We really never really have done the technology piece. Well, now it's all SaaS. It's not servers. It's not difficult, but yet that is the one thing they haven't done. And that's the easiest thing to do. Yeah. Now, 10, 15 years ago, it was very difficult, but there are a tremendous amount of undermanaged businesses. That's the first thing I would say. And then second thing I would say is that the opportunity, whether it's capital providers or whether the opportunity is out there, and for those who are looking for businesses, there's some levers here to pull in a business to make a 25-30% return and bet on yourself. You got to be ambitious, stick with it. It takes a long time to find a prized asset. You might have to buy something that you can fix quickly. Yeah. But those opportunities exist out there, and this $15 trillion that's going to change hands, it's never happened in our country's history. And those are companies as much as it is cash.
100%. I think that's a great point. The under management of these companies, that's the alpha. That's the value.
That's right.
Yeah, that's the value. And a lot of times they start out well managed, and then the last 10 years the sellers wanted to relax, they check out, they limit the growth of the business, they don't want the stress of it anymore.
I think I would add one other thing, Jay, and is whether it's a personal board of advisors or it's a board of directors, a more formal board of directors, too many of these companies have no board. There's no, I'm on a couple of corporate boards, and it's lonely to run a company. And if you gave somebody 1% of the stock and said, hey, meet with me once a quarter,
yeah,
that is not done enough.
100%. 100%. I've seen this many, many times, and I think part of the loneliness also of that journey is that sometimes people have to make certain decisions, and they know what the right decision is, but they just don't have the courage. They don't have someone to back them to just say, yeah, you're making the right decision. Just someone who's invested, like you mentioned, on the board, and someone who can give them the courage that they're making the right decision, and whether it is with strategy or personnel or client, a difficult client, whatever it is, and they just stay, they don't make the decision, and that not making decision compounds over the years.
That's right. That's right. Having a, like I said, I ran a company, and I felt like my board was running the company with me.
Yes.
And I wasn't all alone. And so, your friends, and think about it in terms of I need a legal person, or I need a finance person, or a marketing person, or a operations person. Those people, they like being involved in a business that isn't theirs. It's kind of hey, I'm on a board. It's kind of a professional accomplishment.
Yeah.
Somebody cares about my opinion, which I'm assuming here as we finish up that you've appreciated my opinion.
100%. No, absolutely. And I think a lot of entrepreneurs, they root for each other's success. They want and they feel like they can see the opportunities, and they can see themselves in the person in the seat. they can see themselves, having the emotion around that decision.
I think, yeah, and I think that's why YPO exists,
Yeah.
EO exists, Vistich exists. It's just the peer network to say,
Yeah.
Jesus, my kid, got kicked out of school. I mean, it's personal stuff too in those
Yeah.
organizations.
Yeah, 100%. Thank you. Thank you, James. I appreciate you taking the time.